Welcome to class, students. In today's module 3, we'll be looking at annuity types and pension fund management. Annuity types and pension fund management. So, module content: introduction, basic annuity classification, types of life annuities, variable annuities, death benefits, index annuities, types of pension plans, pension fund actuarial methods, and pension funding and regulations. Introduction: Annuities are financial contracts that provide periodic payments for a specified time period or for life, effect, effectively providing insurance against longevity risks, that is outliving one asset. So they are financial contracts. It provides payment for a specified time period or for life, effectively providing effectively providing insurance against longevity risks. So annuity basic annuity classification are by payment timing, by payment duration, by premium payment. By payment timing, we have immediate annuity and we have the deferred annuity. The immediate annuities is payment begin with 1 year of purchase, while the deferred annuity payment begin at a future date, allowing accumulation period. Payment by payment duration: life annuities, payment continue as long as the annuitant lives. Term certain annuity, payments for fixed period regardless of survival, while the combined annuities are life with period certain life with period certain refund future life. By premium payment: single premium, one lump sum payment, while the flexible premium, multiple payment during accumulation. Types of life annuity: we have the single life annuity. The single life annuity, we have the straight life annuity and the life annuity with period certain. The straight life annuity, that is pure life annuity, provides payment for the annuitant lifetime with no refund features, offers highest periodic payment but all payments cease at death, while life annuity with period certain guarantees payment for a minimum period like 10 to 15 or 20 years. If annuitant dies during the certain period, payments continue to beneficiaries. If annuitant survives the certain period, payments continue for life. It reduces mortality risks for the insurer, slightly lowering periodic payments. We want to look at the life annuities, the types of life annuities. We have the cash fund refund annuity, the installment refund annuity, the modified cash refund. So let's look at the cash refund annuity. If annuitant dies before receiving total payment, if annuitant dies before receiving the total payment, it's equal to the purchase price. The difference is paid as a lump sum to beneficiaries. We have the installment refund annuity, similar to cash refund but pays the difference in the installment rather than a lump sum. Also have the modified cash refund, returns purchase price less payment already received without interest adjustment. Another is the joint and survivor annuity. Is designed for couples. This annuity provide income as long as either annuitant is alive. Joint and survivor annuity continues full payment while both annuitants live. Their continues often at reduced level to the survivor. One of the common options are the 100% joint and survivor, that full payment continues to survivor, the 66 to 30% or 75% joint and survivor, reduce payment to survivor, then 50% joint and survivor, half payment to survivor. So this joint and survivor annuities is designed for purpose, and we have the joint and survivor annuity, and their common options are the 100% joint and survivor full payment continues to survivor. Then we have the 66 to third percent or 75% joint and survivor. Then we have the 50% joint and survivor half full payment to survivor. Some types of term insurance. Joint life annuity pays only while both annuitants are alive, ceasing at the first death, and it is rare. We have the deferred annuity, and characteristics are guaranteed interest rate during the accumulation phase, typically within minimum guarantee of 1 to 3%. We have the fixed period payment during payout phase, and the principal protection for insurance general account. The multi-year guarantee annuity, that is MYGA, similar to the certificate of deposit, offering guaranteed rates for specific period of 3 to 5 to 7 to 10 years. Variable annuities structure: premium allocated to separate accounts with various investment options. Account value fluctuates with investment performance, and annuitant bears investment risk. Potential for higher returns than fixed annuities. We also have the living benefit, that is optional riders. Guaranteed minimum income benefit, that is GMIB. Guaranteed minimum annuitization amount. Guaranteed minimum withdrawal benefit, that is GMWB. Guarantees ability to withdraw specified percentage annually. Then guaranteed minimum accumulation benefit, GMAB. Guarantees minimum account value at specified date. Then guaranteed lifetime withdrawal benefit, that is GLWB. Guarantees lifetime income withdrawals. So benefits are return on premium minimum, highest anniversary value, enhanced death benefit, that is benefit death benefit. Then index annuity, fixed index annuity, that is FIR, credit interest based on acuity index, equity index performance, typically 8 S&P 500. Principal protection with minimum guarantee rate, usually 0 to 1%. They have participation rates, caps and spread limit upside. No direct equity investments. Remains in insurance general account. Crediting methods: annual point to point measure index change over 1 year. Monthly average uses average of monthly index values. We have the monthly point to point with cap. Monthly changes subject to cap. So types of pension plans: we have defined benefit DB plans, and we have the defined contribution PC plans. So pension plan is a retirement plan, of course, saving plan when an employer can contribute to a fund or employee future benefit, providing income payments during retirement. So we have the types of employment. We have the defined benefit plans, which guarantees a specific retirement payout based on a formula like salary and years of service. So we have the defined benefit plans. Employee promises specific retirement benefit based on formula considering year of service, salary, often final average or career average at the age of retirement. The employer bears investment and longevity risk. While the defined contribution, there is discipline. Employer and or employee contribute specified amount to individual account. We have the 401k, 401k, 403b, 573 plans in the United States. Employees bear investment and longevity risk, and financial benefits depends on the contribution and investment. Pension fund actuarial method: we have the actuarial cost method, we have the traditional unit credit method, we have the entry age normal method, and we have the aggregate method and the supporting liability, initial liability. So the guidelines and regulation and the minimum funding requirement, the assets liability management, and the pension risk transfer.